Hello, we are Group 4, and today we're going to be covering the Horsens Iron project. So, what is Horsens Iron? Well, Horsens Iron is a mining company that primarily focuses on the production of iron ore. They operate out in Queensland, New South Wales, and South Australia. So, what is the Horsens Iron project? Well, Horsens Iron has acquired access to a mineral reserve southwest of Broken Hill in South Australia, where they plan to engage in a large-scale mining operation of magnetite ore. After initial investigations, the maiden probable reserve statement of the site estimates around 755 million tons of harvestable magnetite within the area. The company states that it will be initially conducting the excavation at a rate of 10 mtpa, which means million metric tons per annum, with plans to increase this rate to 20 mtpa over a span of a minimum of 20 years. Once the ore has been mined and processed, a slurry pipeline that is 390 kilometers long will transport the concentrate to Maponi Point, where a new deep-water port will be constructed. Once it has been prepared for transportation, the product will be loaded directly onto cargo ships to be sent to the appropriate location. The report and presentation will go much deeper into the financial status of the company. However, a basic comprehension of the Horsens Iron recent financial statements have displayed a low confidence from investors. However, Horsens has stated that multiple steel production companies globally have given direct, unofficial intent to purchase large amounts of the concentrate. As it will be shown, this project will be supporting the international steel manufacturing industry with a steady supply of minerals and business for years to come. For the following and rest of the presentation, we will be looking at the theoretical alternatives of this project, evaluating the financial feasibility of such alternatives. Alternative A will be evaluating the Horsens Iron project if it was excavating the reserve at a rate of 20 mtpa from the start, with no increased rate over time. And alternative B will be analyzing at 25 mtpa. From here, we can draw a conclusion and provide a recommendation for the company moving forward.
The project costs are as follows. Alternative A's initial investment is approximately $50 million, while Alternative B is $63 million. The costs of operation and maintenance for Alternatives A and B are $810 million and $631 million, respectively. Operation and maintenance costs includes the purchasing of machinery and regular maintenance due to high-duty work from mining consistently and workers' wages. These costs are part of the cash outflow.
Project benefit through financial evaluation, we can see that income or revenue is the cash inflow of the project. Both alternative revenues are high due to the dramatic increase of output of 20 million ton and 25 million ton compared to the original project of 10 million ton to be produced in a year. We calculated the margin percentage value to be 60%, indicating every dollar in revenue generated, 60 cents represent profit, while the other remaining is allocated to recovering costs, including production, operating expenses, and taxes. The high margin percentage is seen as more favorable since it implies that a larger portion of revenue is converted into profit, which can be reinvested, distributed to stakeholders, and used to support business growth and sustainability. And market demand is the social benefit, where iron ore is the necessary component of steel making, where it's used all over the world, and its demand is higher than other significant resources, as shown below in the graph. Because our product Horsens Iron provides high-grade iron ore, there will always be a market for it, and particularly relevant as the global moves towards fewer polluting method of creating steel.
Alternative A. I firstly determined a ratio which I used throughout the whole cash flow statement. This was calculated by the difference in time. The original project estimates 751 million tons extracted in a 50-year period, averaging 11 million tons per annum initially. Alternative A will be 20 million tons per annum. To get the ratio, I divided 755 with 20, the new yearly amount, to get 37.75 years. Now I divide 50 with 37.75 to get 1.32 as my ratio. The inflation rate has maintained an average of 2 to 3% over the last 50 years, and we anticipate it to continue at a similar level in the future. For this project, we'll use a 3% inflation rate. For payments to suppliers, interest received and finance costs are started by using 2023's value and multiplying by the ratio. Then I plug that value into the growth formula, and using a 3% inflation rate, we get our values. For payments to plants and equipment, I calculated the growth throughout the last 3 years using the CAGR formula. Adding the calculated percentage from the CAGR formula with the inflation rate, and plugging that value into the growth formula with the previous year's value, I get my estimation. The sale of property, plant, and equipment indicated in previous years has been zero, so we expect it to be the same going forward. Payment for exploration and evaluation assets and proceeds from issues of shares is calculated the same way, using the previous year's value, multiplying it by the ratio, and using the growth formula to account for the inflation. However, cost of issues of shares, I used a ratio formula consisting of cost of issue divided by sale of shares multiplied by 100. Both 2023 and 2022's values were similar, so I averaged them and multiplied that value with the share sales. Lease payments was done the same way. Alternative B's cash flow statement was estimated the same way. However, since Alternative B will be 25 million tons per annum, the total number of years will change to 30.2 years. 30.2 years will be used throughout Alternative B statement for estimation.
By evaluating the financial viability of alternative A and B of the project through using the four financial indicators NPV, IRR, BCR, and PB were all used to determine the project viability. NPV value of both numbers are positive, meaning that over the course of the period of the project, more cash inflow than outflows are anticipated. This implies that the project is feasible and likely to be profitable. Using Excel IRR computation, we were able to determine that alternative A break-even discount rate was 14%, while alternative B was 13.2%, which are both relatively high, suggesting this project to be viable and can be approved. The BCR of both alternatives is larger than 1, implies that the project produced many units of benefit for each unit of expenditure paid, signifying that the concept is both appealing and financially viable. Payback period of both rates have less than 1 month, which is great since it's shorter payback period, hence less risky for the company, because it shows that the investment will quickly recover its initial costs. These indicators suggest the project should move forward because they will positively impact the company. As we can see that from the two alternatives, the company is advised choosing alternative A because it's more profitable and viable than alternative B in every aspect of the financial indicators.
So for the risk assessment, they will be done with quantitative and qualitative analysis. And with the quantitative risk assessment, it will be done using a sensitivity analysis technique to compare both alternative A and alternative B. For the negative risk assessment, there could be heavy project disruption, and in the case of a sudden equipment breakdown, and this will be a problem because of the company's heavy reliance on debt financing, which would make it hard to get back on its feet. And there could also be supply chain issues due to a pandemic, for example, during COVID-19, where everything shuts down, and this could lead to high delays, losses, and instead of profit. And additionally, even maybe employee injuries that could occur on site that may be fatal and costly to the project, causing concerns or even leading to safety violations, which receive regulatory fines. And for the positive risk events, we could have potential for lower inflation, although uncertain. The IMF projects a slowing down of inflation from 3.6% in the past 5 years to an expected 1.6% in the 2023. And this is beneficial because the company can pay back for lesser due to lower rates. And furthermore, with the upcoming technologies, there could be new technologies made, making the operations process quicker. And so we can see through this that the most probable would actually be this inflation rates being lower, but the least probable would probably be the employee injuries situation. However, the most impactful will be the improved technologies and the supply chain issues. For the sensitivity analysis, it compares alternative A and B, and by changing the variables in a range of 20% and negative 20% to calculate the net present value, it shows that the least sensitive for alternative A is the operations and maintenance cost, but for alternative B is the salvage value. However, for both of them, the most important one, the most sensitive, is the benefits. Making sure that they can keep this as stable as possible would lead to making the project and the company have a positive outlook on the investors.
An investigation was done utilizing cash flow statements to calculate project viability indicators for the financial evaluation, and a quantitative and qualitative analysis for project risk assessment was conducted for both alternatives. From this investigation, it can be seen that alternative A is more viable, where the project is designed to produce 20 million tonnes per annum in iron ores, as it has a higher BCR value of 1.2 than alternative B with 1.14. With alternative A being more viable and having an NPV value of approximately $574 billion, it is suggested that Hawthorne Iron is to take on this project. The cash flow statements and analysis conducted clearly indicates that this project would dramatically improve Hawthorne Iron's financial status, where the revenue produced far outweighs the cost associated with the project, hence bringing in a large amount of profits. The initial investments can be seen to be coming from investments from within the company. Therefore, this project would be able to return these investments and provide revenue to put towards company costs or future project ventures. Being able to complete this project would be able to help Hawthorne Iron build upon its reputation in the mining industry and allow for them to be able to take on more projects in the future. Suggestions for Hawthorne Iron would be to research and investigate the market trends and how other mining businesses operate in terms of things such as machinery and hiring contractors. Being able to scope out the cost associated in the mining industry would greatly benefit the company when it comes to managing their operational costs and setting their selling price to allow for the maximum profit while also providing a cost-effective price for clients.